As you reduce your randomness in your actions when it comes to the market, you will be more consistent in what you're doing. You have to balance. You have to have other joys in life. You have to have other hobbies in life. You have to kind of make this a 50-50. My success is dependent on me, not someone else.
If you're always at 1000 and you're ready to go, you're all about excitement and you're going to burn out, right? You want to have setups and routines and processes that keep you in the game for the long term, because that's where the compounding really takes hold.
In mindset is there's some consistency in thought, right? As you reduce your randomness in your actions when it comes to the market, you will be more consistent in what you're doing. You can always tweak a little bit to see what happens at stage 1 and stage 2. But when you migrate or upgrade to stage 3, you have this consistency in routines. Someone like a Mike Webster, he has, Sunday morning, I'll open up charts, I'll run these scans, I'll continuously scan the markets. There's a consistency in what he's doing to build an opinion, right? Mark Minervini does the exact same thing, Saturday morning, Sunday morning, they wake up, they look at the markets objectively, and there's consistency in thought. They don't all of a sudden look at NVIDIA's CEO is selling a whole bunch of shares, and now that's my new edge in the markets, and I haven't studied any of how inside ownership works, and it's trending on Twitter, and there must be some conspiracy that's going on. Let's throw everything I have, in terms of my 3 pillars of success, and all of a sudden they're random in their actions. They don't do that. None of them do that. So there's a consistency in thought process that they exhibit, and that comes through, a whole bunch of failures from stage 1 to stage 2. All those learnings are packaged up for them to be stage 3. The second is inputs and outputs. So inputs and outputs. So as you build and you learn, the only way you can find some sort of consistency in what you're doing is what you're consuming and what you're applying, right? So if I take, let's say, I can be a trader and I could purely trade Fibonacci's. And I guarantee you, if I throw everything else out the door and I trade Fibonacci's for 6 to 8 months, I will find some consistency as to what pattern, what is going on in the markets. All these indicators that we see, right? All these indicators that we see that are named after people, these were wildly successful people that saw a consistency in their inputs and built indicators to see consistency in their outputs. So they operate, that's why I say, and I'll get into this a little bit later, all indicators work. It's a matter of consistent input to see consistent output. Then you tweak your inputs, you get a better output or a worse, and you do that repetitively, right? And repetition, and you can master that particular aspect, whatever it is. If I look at balance sheets, right, and I look at income statements for a span of 8 to 12 months, I guarantee you I'll have a whole different mindset of what I feel true market leaders will be doing based on forecasts, analyst estimates, etc. But it has to be these 2 things, the consistency in your inputs and outputs, so that you could see what is working for you and what isn't working for you, right? I'm an engineer by trade. So my background is in electrical engineering. I think I tend to be more mathematical in my approach. I tend to be more definitive in my approach. I want to see it on paper. Whereas some of you might have a science background or some other background or accounting background or a financial background, right? We will all think in certain ways, but these things don't change. If you're not consistent in your inputs and outputs, and you're not repeating what you're trying to do, you will never see that stage 3 at the end of the day. The fourth is incremental improvement. So this is a process. You will not skip steps. You cannot skip steps. If you're going to be wildly successful, if you're going to be very successful, you have to think that I will improve week to week. I will get better week to week, month to month. And it's not about how do I skip everything? How do I sign up for a service that just negates all of this, and I just instantly and magically can be the best I could be as long as I can just follow someone into a name and get out, etc. That mindset may work in a really, really good market, a really good market where it's you almost like you have a magic wand and someone says, this thing's moving up it's the 2020 market. It's not going to happen for a very, very long time. Those are euphoric times where anything you touch, people are buying, pictures of monkeys and making millions, right? Those times it might work. But if you look at your journey over a bigger span of time, right? If you look at, you have to take steps to internalize what you're learning, to do this yourself and make this a journey about yourself at the end of the day. So this one is longevity over excitement. So a lot of people look for excitement in the markets. They want to buy 2,000 shares of something, have it rip up, and they're super excited. They're over the moon, right? And they want to do that over and over again. It happens. It tends to work. But again, traders that are in this for 2 decades, they hate volatility. They have developed, almost like a block, from a mindset perspective, where if there's volatility, I want to run the other way, because they want to survive. And they know that if they could survive and not catch a landmine, they will be far better off than chasing excitement in the markets, right? This one is self-confidence through market studies. So self-confidence is all about internalizing whatever it is. If you want to go out and trade VWAPs, if you want to go out and trade Fibonacci's, you can go out, grab that knowledge, but you have to internalize any aspect of what you're doing, of your own decision making, and you have to build that self-confidence for you to operate when the market is live and you are ready to make decisions. It all comes down to you and the market. At the end of the day, the market's going to exploit your emotions. You have built systems that kind of minimize those emotions so that you can continuously kind of make rational decisions. But at the end of the day, that's all we're doing, right? And we're doing that again and again, and then seeing differences in our equity curves. This one is about habits and routines. So habits and routines are not, this is not rocket science. These are not, concepts that are solely tied to trading. Habits and routines matter in any professional, sport, any professional, anything. You need to have some sort of habits and routines to keep you, to have balance. I think balance is always forgotten for stage 1 traders, especially. They make the stock market everything, and they're on their desk. They feel like 10 to 12 hours of this, and I'll have some breakthrough indicator that will bypass, we've all been through that, right? Every one of us has been through that. So habits and routines are kind of tapping into, how can I be consistent? How can I have repetition in what I'm doing? And habits and routines kind of play off of that. I think balance is very important. I think at the end of the day, when we're making decisions, if you haven't slept, if you've slept for 4 hours, you wake up at 9:30 and you expect your mind to make a good decision based on what you've done, you're really asking your body to do a little bit too much. So as a professional, as stage 3s, those things matter a lot more. Are you away from the desk enough? Is your mind fresh? When you look at the markets, you've done your prep, you need to go away. You come back at 9:30 or pre-market, whatever the case might be, and you look at things from a fresh, we need our brains to kind of function. And this is a key and, important aspect for many of stage 2s to go to stage 3s, etc. And the last one, it's not just about trading and investing, right? You have to balance. You have to have other joys in life. You have to have other hobbies in life. You have to kind of make this a 50-50. You can't just be here and say, if you read William O'Neill's book in one day, I guarantee you it won't make you profitable, because your mind's not there. You're saturating your efforts in order to be desperate to make something happen in the markets, and desperation doesn't work. And that's with any kind of profession as well. And the last one is managing it like a business. So being a professional is, again, this is not some, trait that is required in trading only. This goes for anything, right? If you own a business and you run a shop, or you need some way of operating that is sane, and you treat it seriously, and you're ready to see results. And that mindset, this is not, I will maybe scan for stocks once a week, and my expectation is I should be up 250%. Or my expectation is I will subscribe to the service. That means I don't need to do anything else. all I need to do is wait for this alert to come through. I'll go buy and my life is going to be great. None of that crap works. At the end of the day, you have to manage your own business. You have to have your own, setups, entries, risk management systems, emotional management systems, etc. And you really have to have a solid business plan. Hey, I am going to do this. Yes, I will go out and get knowledge from somewhere, but I need to internalize that. For my success is dependent on me, not someone else at the end of the day. That's how these traits that we're highlighting, these are traits that successful traders seem to exhibit, right? Maybe they don't exhibit all of these, but for the most part, that this is what they're doing at the end of the day to stop losing money. That's stage 1 to stage 2. And then to go from stage 2 to stage 3, it's more about emotions and improving and tweaking some stuff to get from 2 to stage 3. So Richard, I'll pause there because I've been talking for I don't know how long, but questions, things of that nature that we could discuss.
Yeah, at this point in the chat, everybody leave kind of their thoughts on mindset. I saw some come through, or any questions that you'd like us to cover in this section. We'll kind of pause here and then we'll dive into the edges and setups. So let us know if you have any questions on this. And I think, Rai, as you were talking about this, I was thinking about, how much Stan talked about, especially the kind of middle longevity over excitement, habits and routines, not just about trading, investing. He really stressed to us how important it was to step away, go for a walk on the beach, watch some TV, whatever helps you kind of reset your mind and prepare your body and thoughts, for the next trading day. Super, super important, especially if you want to be doing this for 30 years, 40 years, 50 years. If you're, always at 1,000 and you're ready to go, you're all about excitement, and you're going to burn out, right? You want to have setups and routines and processes that keep you in the game for the long term, because that's where the compounding really takes hold, right?
Yeah. And I see some questions, how long is it going to take me, right? How long is it going to where the a light bulb goes off? And it's different. And I'll give you guys a few examples. So Oliver Kell has been trading before his championship run was 2.5 years, if I'm not mistaken. But less than 5 years, let's say. He was very new, but he figured it out quickly and he saw success in the markets relatively quickly. Me, on the other hand, it took me 7, 8, 9 years to just, go through this, lose a whole bunch of money, lose it again, and then figure it out from there, right? And a lot of this slide contains a lot of pain that I experienced that I wish I could have done a lot sooner to get that 7, 8, 9 years, right, of work, closer to maybe 5, 6, right? It's very rare. And it kind of pisses me off when I see this, but like, hey, sign up for this, and in 2 weeks I'll teach you all the steps you need to know, and you're good to go forever. It just doesn't happen at the end of the day, right? So it takes a little bit of time. If you develop a feel, you develop a gut feel for what the market's going to do as you track it over time, a span of time. You can start to you go from interpreting, right, which a lot of people are big on. I only interpret what the market is doing, and then I place, do this and that with it. As you gain more experience, you go from interpreting to anticipating, right? Interpreting is you're looking at your existing state and you're saying, hey, this is happening, and this is my current, what view on the market. So you go from that to saying, hey, I've seen this before. I think, I'm gonna maybe place some of my bets on, this area of the market being oversold, and it's going to bounce. I've seen this so many times over the span of 15, 20 years that I've been doing this. So that comes with time, right? That comes with market cycles. That comes with studying a whole bunch of market cycles so that you can relate different things to different span, in time. And all of that, at the end of the day, when you place a trade, you get into the state where you have a good feeling about it, and you feel it that, this is pretty good, and you get a bad feeling pretty much right away as well. So like you said, Richard, like intuition is a byproduct of time, right? And these things take time. These won't be, in in stage one, 2 years in stage 1 year in stage 2, and 1 year in year 4, you're so good that if we had that, we would have, everybody at home just trading at the end of the day, and not doing any other, jobs for if that was the case. So it's a bit of a journey. If you survive stage 1, you go to stage 2, the chances are much higher, and you take it seriously, right? You manage it like a business. You move from stage 2 to stage 3 relatively quickly. At the end of the day, it comes down to looking at the reality of what is happening, right? Looking at what you're doing, looking at your inputs and outputs, repeating what you're doing, and try to improve that over a span of, many iterations. That's what kind of boils down to. Many traders tend to mask themselves. If they're not getting results, they still look the other way and say, hey, I'll eventually get results if I just keep trying this and that, rather than looking at, hey, I'm doing this and it's not working for me and I'm not making any money. I need to, fix my issue that I see in my equity curve or my setups that I employ, and these are not working for me. Like, what is going on, right? So it's a little bit of, as humans, we tend to not, expose our own failures, rather than we shy away and hope that they go away one day. Whereas the better, traders that seem to learn quickly look at exactly what they're doing, saying, what the heck am I doing? It's not working. How do I, tend to improve this right away? They look at they magnify their failures a lot more to get to stage 3. So I don't know if that answered it, but
Yeah, I think it takes at least a few market cycles, right? And we just did the class with John Boyk, and many of those legendary traders, it took around 6 years, right? So it takes time, but the harder you study, you study history, you study setups, you study historical winners, you can, accelerate yourself on that path. I think we can push on here, Rai. Let's go ahead and get going. So equity curve mindset, yeah, this is really important. So definitely.
Yeah, so we talked about, making money is not a goal that we could have in stage 1 and 2. I think goals for stage 1 and 2 are having proper processes, routines, habits, consistency, and input, output, and, treating this like a business. You will learn a lot of that in stage 1 and 2 as you go through them. But at the end of the day, if you look at your equity curve, which is what stage 1, 2, and 3 are made of, right? The evolution of a profitable trader, that diagram, stage 3 is seeing higher lows in equity curve, and stage 1 is seeing lower lows in equity curve. So one way to kind of, like I said, look at your results, look at what you're doing, look at what you're doing and why you're doing it, boils down to looking at your equity curve and seeing what happened over here. How can I replicate this as much as possible? How can I replicate this as much as possible? And you'll tie in those common threads. When you look at your equity curves, you'll tie in those common threads and say, hey, looks like when I wait for this XYZ in the markets, and I wait and I'm patient and I look for these things, I tend to be doing well. And when I'm not, operating upon these frameworks, I'm not doing well. And that's the raw truth, right? You're magnifying why you're giving back money to give a little bit less away, and you're magnifying your own successes to see, even if you're a boom bust, you see these spikes and you give it away. You see these spikes and you give it away. You're looking at these spikes, and magnifying those to see, hey, what is going on in this time span or this week? What is going on in this, pullback that I'm experiencing? And at the end of the day, if you have, this is likely 8 or 12 months. You go sideways and you make a whole bunch of money. You go sideways and you make a whole bunch of money. You go sideways and a whole bunch of money, right? And there are these famous quotes by many traders and investors. You seem to, when the market's cooperative, it's much easier. When the market's not cooperative, unless you're some, absolute wizard, you could just trade both sides and you're doing this, and there's no way that you could give anything back. Very rare, again, unicorn type of thing. Doesn't seem to happen. So look at your, I would say, if you're here today and you're looking at, your numbers, if you're not looking at your numbers, you're doing yourself injustice. It's probably why you're still in stage 2. I would say look at why these things are happening, when they're happening, and look at why you're giving back, back money and why that's happening. If you just quantify or try to look at those periods and see, these feel good moments that we have, and then there's nothing to do in the markets, then you have a feel good moment. What is happening in those moments, right? Try to quantify that, try to magnify it, try to look at it so that you could get this higher low at the end of the day, right? So you're making consistent progress. You see you're being rewarded for your efforts that you're putting in. And that in and of itself is a big, mindset. It builds positive mindset. It allows you to stay within your wheelhouse. It allows you to, execute upon the 3 pillars that you put for yourself at the end of the day. So I think this is important. I think a lot of stage 1 traders, if they just look at their equity curve and say, hey, what the hell am I doing? Why am I doing this? Why is it trending downward? They would automatically come to this conclusion that I need to restrain myself. I need to be a little bit less emotional. I need to put in things to stop myself from myself. And that's how you kind of turn that ship around at the end of the day.